There's a financial decision that quietly destroys over $1.4 million of wealth, and millions of people celebrate when they make it. Some even throw parties afterward. They feel responsible, they feel disciplined, they feel financially secure. But what they just did may have cost them a fortune. Today, we're breaking down why paying off a mortgage too early can quietly destroy long-term wealth, and the simple math that can turn a $300,000 decision into a $1.4 million opportunity loss. Later in this video, you'll see why banks quietly love when customers make this decision, and why many people who build real wealth often do the exact opposite, and the surprising level where this mistake quietly begins. Miss this idea, and you might spend the next 20 years celebrating discipline while accidentally slowing down your financial freedom. Because the moment most people make this safe decision, their money stops working for them and starts working for the bank. Let me show you something most people never see. The 20-second math that changes everything. Before we go further, look at the math. If you invest $300,000 and earn an average 10% annual return, compounding becomes powerful over time. After 10 years, that investment grows to roughly $778,000. After 20 years, that same $300,000 can grow to over $2 million. But if you use that money to pay off a mortgage, the compounding engine stops immediately. Yes, you eliminate the interest, but you also eliminate the growth. And that difference alone can quietly exceed $1.4 million. Because the moment money stops compounding, it becomes idle money. Now here's the part almost nobody explains. The loss doesn't happen because people are careless with money. It happens because of three invisible traps in the way most people think about debt, safety, and home ownership. And the first trap is the one almost everyone celebrates. Level 1. The paid-off house. Illusion. Let's start with the psychology of zero. When someone pays off their mortgage, they feel lighter, debt-free, responsible. Emotionally, it feels like progress. But look at what actually happened. You just handed $300,000 to the bank. Your house might now be paid off, but your liquid wealth just dropped to zero. That money is now locked inside the walls of the home. If the roof leaks tomorrow, if the economy shifts, if your income disappears, you can't go to the grocery store and trade drywall for milk. This is what I call dead equity. At the early stages of wealth building, the real enemy isn't always debt. The real enemy is friction. Money trapped inside real estate is slow to access. To reach it, you often need appraisals, loan approvals, paperwork, and closing costs. But money sitting inside an investment account? That can be accessed with a few clicks. Liquidity creates options. And control of capital is often the difference between average financial behavior and real wealth building. Most people want a paid-off house, but wealth builders want control of their capital. Level 2. Why banks quietly love early payoffs. Now, here's something most people never consider. Why do banks actually like early mortgage payoffs? Because they don't sit on that money. They reinvest it. Banks lend money. Banks invest money. Banks compound money. If your mortgage interest rate is around 6%, while long-term market returns average about 10%, that creates a 4% spread. 4% on $300,000 is roughly $12,000 per year. Every time someone rushes to eliminate a low-interest mortgage, they may be handing the bank capital that can generate thousands annually. Think about that. You celebrate paying the bank early, but the bank celebrates something else. Getting your capital back so they can put it back to work. Now imagine if you were the one capturing that growth. Level 3. The $300,000 fork in the road. Imagine two brothers, Taylor and Daniel. Both inherit $300,000. Taylor follows traditional advice and pays off his mortgage immediately. Daniel makes a different decision. He leaves the mortgage alone and invests the $300,000 in a simple index fund, averaging around 10% long-term returns. Years pass. Taylor owns the same paid-off house, but Daniel's investment begins compounding. After 10 years, it grows to about $778,000. After 15 years, it reaches roughly $1.25 million. After 20 years, it climbs past $2 million. Same inheritance. Two completely different financial futures. The difference wasn't discipline, it was compounding. But here's the twist most people never see. Even people who understand compounding still make this mistake. Let me tell you about someone I met years ago named Carl. Carl worked at the same manufacturing company for almost 30 years. He lived modestly and followed traditional financial advice. When he received a $280,000 retirement payout, he made the decision everyone around him praised. He paid off his house. At first, it felt incredible. No mortgage, no monthly payments. But a few years later, the reality appeared. His retirement income felt tight. Medical bills arrived. Inflation kept rising. The house was paid for. But the money that could have grown for him was gone. Carl once told me something I'll never forget. I thought eliminating the payment would create freedom. But what I really needed was income. That lesson changed how I look at money. Question of the day. If you suddenly received $300,000 tomorrow, would you pay off your house? Yes or no? Comment below. Level 4, the hidden wealth curve. Compounding has a strange personality. It hides early. For years, growth feels slow. But once investments cross certain thresholds, like $500,000 or $1 million, something interesting happens. The curve accelerates. Compounding begins doing the heavy lifting. By removing $300,000 from the market early, many people accidentally cut the fuse on their own wealth engine. They trade a future growth machine for a short-term psychological win. But feelings don't compound. Assets do. Level 5. The risk most people miscalculate. Yes, paying off a house can reduce financial stress. Lower monthly expenses can absolutely create peace of mind. But wealth decisions aren't only about eliminating risk. They're about opportunity cost. Because the real danger isn't having a mortgage. The real danger is having no assets growing. A paid-off house with no investments still leaves you dependent on your next paycheck. But a $300,000 portfolio can generate income. Using a simple 4% withdrawal rule, that portfolio could produce around $12,000 per year without touching the principal. That's the difference between eliminating debt and building assets. Level 6. The wealth identity flip. The biggest difference between average financial behavior and wealth building isn't intelligence. It's identity. Most people aim to become debt-free. But wealth builders aim to become asset-rich. They understand that efficient debt can sometimes be a ladder, not a prison. Because the real goal isn't eliminating payments. The real goal is building assets powerful enough to pay the bills for you. Being debt-free might feel safe, but safe doesn't always build wealth. Liquidity creates options. Assets create income. Compounding creates freedom. Debt isn't always the enemy. Idle money is. Because idle money never compounds. Assets do. Now that you understand why paying off a mortgage too early can quietly destroy long-term wealth, the next thing you need to learn is how wealthy investors actually use debt and liquidity together to accelerate their financial timeline. I break down that strategy in my next video. You don't want to miss it. See you in the next video.